All right. Pull up your chart. At OpenTradingView, OpenInvesting.com, open whatever you use, because what I'm about to walk you through happened in real time today, and I want you to see it on your own screen, not just mine. Because when you can see it yourself, nobody can lie to you about what it means. Silver exploded over 4% today. Silver is up more than 4% on the day, gaining alongside gold as the metals wrap up a volatile March together. And it didn't just go up 4%. It went up 4% and broke through a technical level that institutional traders have been watching for weeks. The 50-day EMA being broken to the upside could open up the possibility of a move to the $80 level, which of course is a large, round, psychologically significant figure in and of itself. That is what happened today. And I need to walk you through exactly what it means, what it doesn't mean, and what the honest risk-reward setup looks like from here. Because a 4% day in silver is not unusual in this environment. We've had 4% days in both directions all quarter. What makes today different is where the move happened on the chart and what technical barrier it just cleared. Let's get into it. What actually happened today? The tape. Let me just lay out the raw facts first, because facts are the only foundation worth building analysis on. As of March 31, 2026 at 12:18 p.m. EDT, the live silver spot price for 1 ounce of silver in US dollars is $74.57. That's up more than $3 from Friday's close. The price of silver is $74.90 per ounce as of April 1st, 2026, according to Priority Gold, a precious metals dealer. That's up dramatically from just $31 for the same amount of metal in January 2025. Silver has rallied hard on Tuesday as we are reacting to falling yields in the United States. U.S. interest rates remain the dominant driver, with the 10-year Treasury yield recently hitting 4.4%. Any softening in yields would provide meaningful support for silver heading into April. So what drove today's move? Two things working simultaneously. First, U.S. Treasury yields dropped. Interest rates in the United States have dropped a bit as we tested the 4.30 level, but it has held so far. When bond yields fall, the opportunity cost of holding non-yielding assets like silver decreases. That makes silver relatively more attractive compared to fixed income. It's not complicated. It's just math. Second, and this is the geopolitical angle, the conflicting signals regarding the US-Iran peace negotiations continue to fuel volatility in the financial markets. Besides, the positive Chinese manufacturing data released earlier in the day pointed to the white metal's steady industrial demand. So you had a macro tailwind from falling yields, a geopolitical tailwind from continued uncertainty, and an industrial demand signal from positive Chinese data, all hitting at the same time on the first trading day of Q2. That confluence is what drove the 4% plus move. The technical significance? Why the 50-day EMA matters. Now let me explain why this particular 4% day is different from all the other volatile days we've had this quarter. And it comes down to one line on the chart, the 50-day exponential moving average. The 50 EMA trading strategy is a widely used technical analysis tool that helps traders identify medium-term market trends and generate buy or sell signals. By focusing on the 50-day EMA, this strategy offers a balanced approach between responsiveness to recent price changes and the smoothing out of short-term fluctuations. Here's what you need to understand about the 50-day EMA and why institutional traders pay so much attention to it. The slope of the 50 EMA line indicates the market trend. An upsloping indicator line, with the price predominantly above it, indicates an uptrend, while a downsloping indicator line, with the price below it, indicates a downtrend. Silver has been trading below its 50-day EMA for essentially the entire month of March. Silver price deepened its losses during recent intraday trading after failing to break the key resistance level at $74.50. The price has since come under negative pressure, trading below EMA 50. Every rally attempt during the month was rejected at this level. The 50-day EMA became a ceiling, a line that institutional sellers defended repeatedly, until today. Today, silver didn't just touch the 50-day EMA. It punched through it. It closed above it. And that changes the medium-term technical picture fundamentally. The 50-day EMA being broken to the upside could open up the possibility of a move to the $80 level. Now, I want to be very precise about what breaking above the 50-day EMA means and what it doesn't mean. Because the AI channels are going to take this move and tell you silver is going to $200 by Friday, and that's not what this means. What it means is that the medium-term trend, which has been definitively bearish since the January peak, has shifted from bearish to neutral to bullish. The sellers who were defending this level either absorbed their position or stepped aside. The buyers overwhelmed them. That's a shift in the balance of power on the medium-term time frame. What it doesn't mean is that the all clear has sounded. A single day above the 50-day EMA is encouraging but not definitive. What technicians want to see is confirmation, ideally, a second close above the level, followed by a successful retest where the 50-day EMA acts as support instead of resistance. That's the classic flip. Resistance becomes support, old ceiling becomes new floor. If that happens in the next 2 to 5 trading days, the path toward $78 to $80 becomes the base case. If it fails, if silver drops back below the 50-day EMA tomorrow or the day after, then today was a false breakout, a failed test, and the neutral to bearish picture remains intact. I don't know which outcome we'll get, but I know exactly what to watch for, and now so do you. The bigger picture, where $80 fits in the structural map. Let me zoom out, because a 4% day and a 50-day EMA break don't exist in a vacuum. They exist within a larger structural context. And that context matters enormously for evaluating whether this move has legs or is just another head fake in a volatile quarter. $94 is the current upper consolidation band, $80 is the mid-channel 50-day EMA support, and $60 is the bear scenario target near the 200-day EMA. So $80 isn't just a round number. It's the mid-channel level on the broader trend. It's where the 50-day EMA had been sitting before the March correction dragged it lower. And it's the first zone of serious institutional resistance above the current breakout. Between here and $80, there's relatively thin technical resistance. The daily chart shows some minor congestion around $76 to 70 cents setter, but nothing like the brick wall that existed at the 50-day EMA. If silver can hold above the 50 EMA through this week, the path to $78 to $80 is mechanically clear. Across these sources, silver predictions converge on $80–92 as the near-term trading range, with JP Morgan anchoring the institutional consensus near $81 as an annual average. Now let me put the institutional targets on the map, because this is critical context. JP Morgan Global Research sees silver prices averaging 81 Oz in 2026. Bank of America maintains a target of 135. Silver could reach $100 per ounce by March, and potentially 110 by the second half of 2026, according to Citigroup's forecast. Current price approximately 75s. Every major institutional desk has silver higher from here. Not one has a year-end target below current levels. Today's breakout above the 50-day EMA is the first technical signal that aligns with the institutional consensus since the March correction began. And this is important, institutional targets are opinions, not guarantees. The institutions have been wrong plenty of times. Citi called for $100 by March and we got $61 instead. So treat these targets as context, not prophecy. The fundamental fuel, what's under the hood? Now let me connect the technical breakout to the fundamentals, because technicals without fundamentals are just lines on a screen. The silver market is in its sixth consecutive year of supply deficit. The 2026 shortfall is projected at 67 million ounces. The cumulative 5-year deficit exceeds 800 million ounces, an entire year of mine production consumed and never replaced. The supply side of the silver market is now one of its most critical drivers. Global silver supply fell from 1.07 billion Oz in 2010 to roughly 1.03 billion Oz in 2024 and remained constrained in 2025. Silver has remained in a structural deficit since 2021, with the cumulative supply shortfall from 2021 to 2025 nearing 800 million ounces. On the demand side, investment demand is surging, while industrial demand is experiencing a compositional shift. Physical investment is projected up 20% to 227 million ounces. Industrial fabrication is declining slightly due to thrifting in the solar sector, manufacturers reducing silver content per panel as prices have tripled. That's a headwind I won't hide from you. But the net picture is still a deficit. The market still needs to draw down above-ground inventories every single year to balance supply and demand. And that structural tension is the fundamental fuel underneath today's 4% move. The COMEX reality check. Let me address COMEX because I know it's the first thing you're going to hear about on the other channels tonight. Registered silver has declined 13.9% over the past 30 days, 12.3 Oz withdrawn. Coverage ratio stands at 13.4%. Stress? Paper leverage is elevated at 7.4 stag. Significantly more paper claims than deliverable metal. At the current withdrawal pace, registered silver would be exhausted in all 124 trading days. That's the data. It's tight. It's stressed. It's worth monitoring. Now here's the honest context that the AI channels won't give you. With 400 million ounces of open interest and only 100 million ounces registered, headlines suggest a breaking point. But the math behind the panic misunderstands how futures delivery actually works. COMEX inventories represent a portion of total global supply. Media often reports total COMEX silver, registered plus eligible, which sounds large. But eligible silver may not be for sale at any price. Owners may be holding it for their own purposes. Only registered silver is available to satisfy futures delivery demands. Is the situation genuinely tight? Yes. Has it been tightening for years? Registered silver, the portion available for delivery, has dropped over 70% from its 2021 highs. That's a real structural shift. But I refuse to tell you COMEX is defaulting tonight when they said the same thing last week and the week before and the week before that. When something genuinely changes in the delivery mechanics, not incrementally tightens but structurally breaks, I will tell you clearly. And you'll trust me when I do, because I won't have burned that trust with 100 false alarms. What could go wrong? The honest bear case. Okay, I've given you the bullish technical signal, the bullish fundamental backdrop, and the bullish institutional targets. Now let me do something no AI channel will ever do, give you the bear case. With war headlines coming out randomly, be careful with your position size. This is going to continue to be a volatile market from what I see. Here are the specific risks that could invalidate today's breakout. First, the dollar. If the dollar index reverses higher, which it could do on any hawkish Fed comment or positive U.S. economic data, it will pressure silver mechanically. One of the biggest downsides would be something that just calls into question this broader precious metals rally. Whether or not that's a materially hawkish shift by the Federal Reserve, or if we were to see gold come under pressure by some of its structural drivers unwinding, silver is going to continue to price off that in a more volatile manner. That's not me. That's JP Morgan's Greg Shearer, their head of precious metals research. Second, the data this week. Today's JOLTS job openings data, followed by ADP payrolls and ISM manufacturing on Wednesday and non-farm payrolls on Friday, will be closely watched for signals on the Fed's path and silver's next move. If the jobs data comes in hot, rate cut expectations get pushed back, yields spike, the dollar strengthens, and today's breakout could fail spectacularly. That is a real risk sitting right in front of us. Third, the CME's margin policy. Remember what happened in late January. The CME hiked margins from 15% to 18% and triggered a 39% crash. U.S. Treasury Secretary Scott Bessent reiterated that recent extreme swings were driven by speculative activity, particularly from Chinese traders. If today's move sparks another wave of speculative long positioning, the CME could respond with another margin hike. They've done it before, multiple times. And each time it's punished leveraged longs. Fourth, silver's dual identity. SLV's rally is fueled by speculation, persistent supply deficits, and gold's strength. Yet industrial demand is softening and AI EV narratives may be overstated. Silver is 60% plus industrial metal. If recession fears intensify, which they easily could from an escalating war, trade disruptions, or collapsing consumer confidence, the industrial demand component gets repriced downward. I'm not saying any of these will happen. I'm saying they could happen and you need to be aware of them before you make decisions with your money. The 4-level framework, what to watch this week. Here's my exact framework for evaluating whether today's breakout is real or false. Pin this. Screenshot it. Check it against the chart every day this week. Level 1. Silver holds above the 50-day EMA through Wednesday's close. If it does, the breakout is confirmed. Resistance has flipped to support. The path to $78 to $80 is open. This is the most bullish near-term outcome. Level 2. Silver closes above the 50-day EMA today, but falls back below it by Wednesday. This is a failed breakout, a bull trap. It means today's move was driven by short covering and yield-driven momentum, but there wasn't enough genuine follow-through buying to sustain it. In this scenario, expect a retest of $71 to $72 support. Level 3, silver rallies to $78 to $80 by end of week. This would be a powerful confirmation of the Q2 trend change, but be extremely cautious about chasing at $80. It's a massive psychological round number and the kind of level where institutions take profits and the CME considers margin adjustments. The 50-day EMA being broken to the upside could open up the possibility of a move to the $80 level, which of course is a large, round, psychologically significant figure in and of itself. Right now it's a good start, but we'll see whether or not the silver market can really take off. Level 4, non-farm payrolls on Friday. This is the event risk. Everything I've said about the technical setup could get overridden by a single data print on Friday morning. If payrolls come in strong, the Fed narrative shifts hawkish, yields spike, dollar strengthens, and silver gives back the entire week's gains. If payrolls come in weak, rate cut expectations increase, yields fall further, and today's breakout gets rocket fuel. I don't know what the payroll number will be. I don't have a crystal ball, but I know the event is on Friday, and I know it matters more than any technical level I've drawn on any chart. Be positioned accordingly. My honest assessment. Here's where I land. Today's 4% move and the 50-day EMA break are genuinely significant. This is the first medium-term bullish technical signal since the January peak. It aligns with the structural supply deficit, aligns with institutional targets, and was driven by fundamental catalysts, falling yields, and positive Chinese industrial data, not just speculative momentum. But one day does not make a trend. I want to see confirmation through Wednesday. I want to see the 50-day EMA act as support on a pullback, and I want to get through Friday's payroll data before I increase my confidence level from cautiously constructive to actively bullish. If you're a physical holder, today is confirmation that the correction may be nearing its end. That's encouraging. Don't sell. If you're thinking about buying, today is not the day to go all in. It's the day to put this move on your watch list and define your entry rules. If silver holds the 50-day EMA through Wednesday, that's a stronger signal. If it retests the EMA and bounces, even stronger. Patience costs nothing. FOMO costs everything. If you're in leverage positions, Friday is your risk event. Size accordingly. The track record note. I said last week that the Q1 close at 73 would be the key inflection point. Today's 4% rally from that level suggests the Q1 close did act as a launch pad. That call is looking correct so far. But so far is doing a lot of work in that sentence. I'll update the track record at the end of this week when we have the full picture, including payrolls. The 50-day EMA is broken. The path to 80 is open. But the path is not the same as the destination. Watch the levels. Wait for confirmation. And don't let anyone, including me, tell you certainty exists in a market that just traded a $30 range in a single month. I'm John A.G. Truth. Stay rational. Watch the EMA. And I'll see you Wednesday with the confirmation check.